Hi everyone, and thank you for joining us for this event to celebrate the Earth Day 2017. I'm Tanya Svidler. I'm a Director of ESG Solutions here at Morningstar in Chicago. And I'm joined here today by Julie Koska.
Hi everyone, thank you for joining today. I'm Julie Koska and I'm the Director of Project and Product Management at Morningstar for our Sustainable Investing solution.
So as many of you know, Earth Day was launched in the late 70s to really raise awareness for the environmental issues facing the planet. About 20 years later, Earth Day became global. And just as the Earth Day has evolved, so has sustainable investing, which is integrating environmental, social, and governance considerations into the investment process. And we want to take this opportunity today to talk about sustainable investing, because environmental is really the main driver in sustainability-focused investing.
So to kick things off, Tanya, what is sustainable investing and how has it evolved?
So, as I have mentioned, sustainable investing is really looking to integrate environmental, social, and governance considerations into the investment process. It's also known by the term ESG investing, which is the acronym for environmental, social, and governance factors. It's typically perceived as a very complex space, but in reality, there are three predominant dimensions to it. It's values alignment, ESG risk mitigation or ESG integration, and impact. Values alignment is really where ESG investing has originated from. It's associated with exclusionary screening that is looking to align the portfolio with investors' beliefs. So, as you know, it primarily originated from the faith-based investors that were looking to exclude the categories of stocks that they were not comfortable with. So typically those are the sin stocks, alcohol, tobacco, gambling, controversial weapons, etc. Now, since then, sustainable investing has really evolved more into focusing on ESG integration. So really looking into how well are the companies addressing environmental, social, and governance risks that they're facing. And examples of those risks are carbon emissions, water stress, land and biodiversity impact. On the social side, it's labor relations, it's product safety, it's health and safety records. On the governance side, it's really diversity on boards, it's the presence of independent audit, it's the compensation structures. So when companies are considered sustainable, it means that they really manage those ESG risks very well comparing to the industry peers. And so this type of investing is really known as kind of best-in-class ESG integration. And finally, impact is a dimension that continues receiving some investor interest. And it's looking to really create strategies that are aiming to generate positive social and environmental impact. So examples of that are investments into renewable energy, into green bonds, into access to capital, access to healthcare, pollution prevention, etc., etc. In general, sustainable investing has been receiving a tremendous amount of interest globally. And a lot of investors that choose to integrate ESG considerations decide to sign on to United Nations-backed Principles for Responsible Investing. And this initiative is just over 10 years old, and at this point it really counts some of the largest money managers and pension plans globally as its signatories. So right now they have over 1,700 signatories and over $63 trillion that are being invested with ESG considerations.
Yeah, and specifically in the U.S., the U.S. Forum for Sustainable and Responsible Investment just conducted their biannual, so every other year, study in 2016 to look at the size of the U.S. sustainable investing market, and they found that that size now is $8.72 trillion. which was 33% growth over the 2014 rates. So we're, again, really seeing across all regions in the world pretty significant growth when it pertains to sustainable investing. And furthermore, we've also seen tremendous growth from retail investors. Those similar studies have shown that now 25% of all sustainable investments come from retail investors. And that's over double the rate that it was in 2014. And so there's really significant increases that we're seeing there. Tanya, would you say that some issues are dominating sustainable investing, or are they equally prevalent?
Yeah, I would say that environmental is absolutely leading the trend. And environmental investing really can be done in many different ways, but I would say that the majority of investors is either looking to exclude fossil fuels entirely from their portfolios, or is looking to exclude just the most carbon-intensive fossil fuels, such as coal or tar sands. And then the second form that really is being expressed globally is low-carbon investing. And low-carbon investing is really looking to tilt towards companies that have lower carbon emissions comparing to their industry peers. So in the utility space, for example, those utilities that have very little coal in their fossil fuel mix typically end up being much less carbon intensive. And so those types of portfolios usually provide bigger exposure to these types of investments. And of course, the renewable energy is receiving a lot of interest as well. And so do green bonds, where 100% of proceeds are dedicated to green projects. So, Julie, would you tell us a little bit more about the sustainability initiative at Morningstar?
Sure. So we started our sustainable investing initiative here at Morningstar several years ago. We really were recognizing that when it came to investors' interests, there really was a lack of sustainable investing options within 401k or retirement plans. And that really was stemming from the fact that there were very few what we call intentional funds that existed in the marketplace, or funds that had a specific designation towards ESG factors. And so what we wanted to do was really look at what was underlying fund portfolios and find a way to surface those underlying holdings' exposure to sustainability or to ESG factors. So what we did was we partnered with a firm called Sustainalytics. Sustainalytics has been in the business of focusing on ESG and corporate governance research for over 25 years. And so we worked with them to take in their data and be able to aggregate that information up to the portfolio level. We took that information then that we aggregated up at the portfolio level based off of the asset weights within the portfolio level to create a sustainability rating or globe rating for funds, which is where we compare funds against their peers across Morningstar categories. And today, that has now expanded from our initial universe of 20,000 funds globally to over 35,000 funds globally, spanning open-end funds, ETFs, exchange-traded funds, closed-end funds, and other investment instruments. So Tanya, as you may know, one of the biggest hurdles to adopting sustainable investing is that it's often associated with underperformance. Can you help clarify this?
Yeah, absolutely. It's a great question. I would say that this underperformance issue is really a very broad misconception. I would say that some of the traditional socially responsible strategies were very much exclusionary in nature. And naturally, when investors are limiting the universe based on ethical views, often they would end up with a much smaller investment universe, and it often would end up missing out on some of the high dividend yield paying stocks, since a lot of the stocks in controversial categories would end up being very high dividend yield paying ones, like alcohol, tobacco, gambling, and many other controversial categories. However, ESG integration, or best-in-class kind of approach, is really looking at companies that really manage their ESG risks in the best possible way. So these types of companies actually end up being much more sustainable in the long run, and they tend to be less volatile, they tend to have lower cost of capital, and they very often tend to be much less prone to governance and accounting-related irregularities. So those funds that have higher sustainability credentials actually end up performing better. And here at Morningstar, as most of you know, we have not only sustainability ratings for funds, but also the star ratings, which are doing traditional risk-return assessment. And so our head of sustainability research, John Hale, has actually done multiple studies that look at performance of the high globe rated strategies, which is how we express our sustainability ratings, versus the high star rating strategies. And what findings show is that actually high globe strategies actually very often end up being really strong financial performers as well. And they often end up being much less volatile, have much higher financial health, and much stronger economic moats than the traditional funds.
And John Hale has also recently published a paper that looks at the quality of ESG funds, which is a piece that we're making available to all of our listeners here today.
Mm-hmm. Now, Julie, you just came back from speaking at a number of quite large events geared towards financial advisors. Would you share some of your comments on that, please?
Yeah, absolutely. But first, I wanted to mention that we look a lot at other statistics and information that asset managers put together around sustainable investing, as well as Morningstar's research. And so I first wanted to highlight one of the recent studies that TIAA conducted, where they found that increasingly investors, in fact 74% of them that they surveyed, want to work with a financial advisor who takes into account and incorporates investments that have not only strong financial characteristics, but also perform well from a sustainability perspective. So keeping that in mind, we also have conducted a number of webinars recently. So we presented, John Hale, our head of research, presented at a webinar that we did with RIA database last month. And we're really seeing a surge in advisor interest because we had over 2,000 advisors who registered for that webinar, and over 1,000 of them attended John's session. And furthermore, from my recent visits, what I was finding is that most advisors, at least that are attending these type of events, they have enough information and they've started to have dialogue with their clients related to impact and to aligning their investors' interests with their values. But what they're really looking to expand upon is have a better understanding of the stories behind sustainable investing. So really getting down to understand why a particular asset manager has selected a company for a portfolio that's sustainable. And what we're also seeing too is that increasingly advisors, if they're not starting to think about how to incorporate sustainability into their conversations with their clients, they're starting to think about doing so. In fact, a recent survey that we conducted with the RIA database found that 60% of advisors are going to start incorporating sustainability into their practices. So given that there's so much interest in sustainable investing, Tanya, can you talk a little bit more about what advisors can do to incorporate sustainability into their practice, especially given that so many of our clients are advisors?
Absolutely. So I think a great starting point is really to start asking questions. And as you know, newer wealth holders, women, millennials, they think in a much more progressive terms, and they, a lot of them really want to have their views incorporated in the way their money is being managed. And what's important is that actually none of them want to sacrifice the returns in that process. So I think a really great starting point for our financial advisor clients would be to start having those conversations. When you're doing an assessment for your client and you're trying to understand what the goals are, what the outcomes are supposed to be, really start bringing up sustainability. And don't think about it as an abstract term that is just looking at some obscure categories. Sustainability at its core is actually literally just looking at a wider set of criteria that helps assess a portfolio from a much more profound perspective. And sustainability really helps you to make sure that the portfolio is going to perform really well in the long run. And for a lot of your clients that are looking to retire in 20, 30, 40 years from now, this is actually going to play a really important role. So at this point, there are transparent metrics that are available to you, such as sustainability ratings for funds that we have constructed at Morningstar, that allow you to look at the sustainability credentials as well as the financial ones. So when you're doing your fund selection, when you're thinking about the style boxes, you can always look at the funds that are performing well from risk-return perspective, and at the same time, look at the funds that are performing really well from sustainability perspective. And just as simple as bringing up that question to your clients and asking if you were to choose from two funds that have equal financial characteristics, and one had 5 Globe sustainability rating, which is the highest one, and the other one had a 1 Globe rating, which one would you choose? Would you care? A lot of times the answer would be that clients would actually have preference for funds that are not only strong financial performers, but also have really strong sustainability performance. The sustainability ratings that Morningstar has created are actually publicly available. You can see them on Morningstar.com. You can see them in the Morningstar Direct platforms for those of you who have access to that. So just keep bringing it up.
Yeah, and also too, on my recent travels, I came across an advisor who was talking about how he would incorporate sustainable investing into his conversations with clients. And that by doing so, it actually helped him to really retain his clients during the most recent recession period. In fact, he was able to retain 99% of his clients because he went beyond just having the traditional conversation about financial performance to really dig deeper into discussing his specific clients' interest and values and impact that they wanted to make through investments. In addition to some of the tools that you mentioned, Tanya, I also wanted to talk about some of the new offerings that we're about to roll out here at Morningstar that can really help advisors understand our sustainability metrics. So we have these sustainability metrics. There's about 45 of them that are available at the funds level. And we are seeking to make that information a lot more transparent through a fund report that we have actually just launched today. Our clients are able to look at and view that report to get a better understanding of what the individual contributors are, so the holdings within the portfolio, how they roll up and contribute to the overall sustainability score and rating for a fund, as well as be able to see the different dimensions around the calculation of our sustainability metrics, like the sustainability score and rating. And additionally, we will be rolling out a set of new data feeds next week to provide more details around the company level that obviously contributes to the overall sustainability metrics that we have for portfolios. So those data feeds will provide more information around what the underlying ESG scores are in the portfolio, and also allow wealth managers with being able to select different stocks based off of their sustainability levels. We plan to host a webinar in May related to these new company level data feed offerings. Before we wrap up today, we'd like to check to see if we have any Q&A from the audience.
So one of the questions from the audience is from Jamie. How has the Morningstar sustainability rating been received by the industry? So actually, it's a great question. We've launched our sustainability ratings for funds in March of last year, and it has been an incredible evolution because what Morningstar has done by the sustainability rating creation is really we've revolutionized the portfolio transparency. And a lot of investors have realized that they can assess how well the fund managers are managing the strategies, and the ratings themselves are actually not necessarily judging the managers, but they really are helping investors assess the underlying quality, the underlying sustainability of the fund strategy. And what has transpired is that a lot of the managers that are running really strong fundamentals-driven processes that are looking at a very broad range of factors actually ended up scoring really highly on the globes, even without having that intentional ESG mandate. And so what we start seeing more and more is that the industry is starting to use the globe ratings for articulating the strengths of the investment strategies. We see more and more money managers publish the sustainability ratings alongside the financial metrics. We see them showing the sustainability selection option alongside the financial selection option. And we see a lot more interest from the retail clients, which I think is really most important here.
Great. Let's see if we have any other questions from the audience today.
So the next question is from Fernando. Are there any options for investors who want to invest in climate risk mitigation strategies? The answer is absolutely. There has been a wealth of options that is currently available. Just the last couple of years have seen a tremendous amount of issuances related to environmental funds. And as I have touched on earlier, some options are looking to exclude fossil fuels, others are looking to invest into low carbon tilted strategies, others look to invest into green bonds and into green equity options. So with regards to ex-fossil fuels, some of the traditional socially responsible managers now have strategies that are excluding fossil fuels. Green Century is one of them. Then State Street has multiple options for fossil fuel exclusion. iShares has a product that excludes fossil fuels, and many other mainstream managers have that as well. With regards to low carbon strategies, also State Street as well as iShares have low carbon products. Aperio, Parnassus, many other managers are launching more and more low carbon strategies. Mellon Capital is one of them as well. And then with regards to green bonds, there is also a wealth of options domestically as well as internationally. But I think an important point to understand is that when investors are looking to invest into portfolios that have higher sustainability profiles, because environmental is such a strong dimension in this, they are already contributing to that positive environmental impact.
Right, so it looks like we have another question here from Marcy. And the question is, are there thoughts or plans to include other resources in addition to Sustainalytics? Our understanding is the ratings are contingent on who they are tracking. It's a great question, Marcy. Right now, we are working very closely with Sustainalytics, and we continue to develop other aspects that we hope to expand into as it pertains to our sustainability rating calculations and other metrics that we're producing relative to sustainability. At this time, there aren't any plans in the works in terms of working with other firms, but we're open to other conversations and other discussions, so we'll see where things evolve. This is always, our sustainable investing effort is very much an iterative effort, so there will continue to be new offerings and new aspects that we continue to launch, as well as data that we're looking to collect ourselves, given Morningstar's strong background and focus on data.
Thank you. So it looks like we don't have any more questions at this time.
So I want to thank everyone for joining us today. If you'd like to learn more about our sustainability rating, please visit the link that's in the description of this video. Please like Morningstar's Facebook page so that you can be notified whenever we go live again. And then, as I mentioned, we will have a webinar in May that's focused on our new company level ESG data offerings, and we invite all of you to attend that webinar to learn more about our offerings. So thank you for joining today.
Thank you.